Every insurance company in the world operates on one foundational mathematical certainty. On average, across all their customers, they pay out less than they collect. If that were not true, they would not exist. Which means, on average, across all their customers, insurance is a losing financial transaction for the customer. Here is the rewritten text. The insurance industry never says this out loud, but their entire business model requires it to be true. On average, across all their policyholders, they pay out less in claims than they collect in premiums. This is not a criticism, it is math. If insurance companies paid out more than they collected, they would not be in business. But here is what that mathematical reality means for you as an individual customer. On average, if you are a typical policyholder, you will pay more in premiums over your lifetime than you receive in claims. Not always. Catastrophic events do happen, and insurance is genuinely valuable when they do. However, averaged across a lifetime of premiums on all the various products most people carry, the expected value calculation favors the insurer. This is the case every time, by design. The question worth asking is not whether insurance is a good or bad product. Some categories of insurance are genuinely essential, and the math strongly supports carrying them. Others, however, are primarily products of fear, marketed at the exact psychological moment you are most likely to buy something you do not strictly need. By the end of this video, you will understand how to tell the difference, and what the industry counts on most people never figuring out. Let us start with how the pricing actually works. To understand where insurance goes from essential to exploitative, you first need to understand how insurers actually price risk. Insurance pricing is built on actuarial mathematics, the statistical analysis of large populations to estimate the probability and cost of specific events occurring. An insurer selling car insurance knows, with reasonable statistical precision, what percentage of their policyholders will file a claim in a given year, the average cost of those claims, and how those numbers vary by driver age, location, vehicle type, and driving history. From this data, they set a premium that, across their entire book of business, covers expected claims, operating costs, and a profit margin. The individual customer is not paying the expected cost of their specific claims. They are paying a share of the pooled expected cost of the entire customer population, plus the insurer's margin. This pooling is the genuine social value of insurance. By spreading the cost of catastrophic events across many people, insurance makes individually devastating outcomes financially survivable. A house fire that would destroy one family's finances becomes a manageable shared cost across thousands of policyholders. That function is real and valuable. But here is where pricing becomes profitable at the customer's expense rather than in their interest. Insurance companies are not neutral statisticians. They are profit-seeking businesses. Their goal is not to price risk at exactly its expected cost. Their goal is to price risk at what the market will bear, which is driven not purely by statistical risk, but by how much fear the customer feels about a specific outcome. Fear is not perfectly correlated with statistical risk. A customer who is deeply afraid of a low-probability event will pay substantially more than its actuarial value to insure against it. An insurer who correctly identifies that fear and prices accordingly captures a larger margin. This is not fraud. It is pricing psychology. The insurance industry has spent decades refining its understanding of exactly which fears drive the most premium above actuarial value, and marketing accordingly. Extended warranties, travel insurance, and accidental damage coverage on consumer electronics, dental and vision add-ons priced above their expected benefit value. Each of these products exists in a category where the gap between what customers fear and what the actuarial math actually supports is reliably large and reliably profitable. Now, let us go deeper into the specific psychological mechanisms the insurance industry relies on. Because selling insurance is not primarily a statistical exercise for the customer, it is an emotional one. The first mechanism is called loss aversion. Behavioral economists, including the work of Daniel Kahneman, that we have covered in a previous video on this channel, have documented that humans experience the pain of losing something at roughly twice the intensity of the pleasure of gaining something of equivalent value. Insurance is sold almost entirely by activating loss aversion. You are not buying the positive value of coverage. You are buying relief from the pain of imagining the loss. The marketing language of insurance products consistently emphasizes what you could lose without coverage, rather than what the statistical probability of that loss actually is. Protect your family. Safeguard your future. What would happen if you lost everything? These are loss aversion triggers, not risk assessments. The second mechanism is the availability heuristic, a cognitive bias where the perceived probability of an event increases based on how easily you can recall a vivid example of it occurring. After seeing a news story about a house fire, people consistently overestimate the probability of their own house burning down. After a natural disaster story in the news, sales of disaster-related insurance products spike. Not because the actual statistical risk changed, but because the vivid example made the event feel more likely than it statistically is. Insurance companies understand this mechanism. Their advertising and marketing timing is not random. Products are promoted more heavily in the aftermath of events that increase the availability of vivid, frightening scenarios in potential customers' minds. The third mechanism is what behavioral economists call the certainty effect. People are willing to pay a disproportionately large premium to convert a small probability of a large loss into zero probability. Moving from a 2% chance of losing $10,000 to a 0% chance feels like an enormous relief, even if the expected value of that 2% risk is only $200. People will pay substantially more than $200 for that certainty. Insurance companies price low-probability, high-impact products to capture this certainty premium, selling peace of mind at a significant markup above expected actuarial value. Now, here is the important caveat. For genuinely catastrophic risks, events whose financial impact would be permanently life-altering, paying above actuarial value for certainty is often a rational decision. A house fire or a serious medical event can destroy a family's finances permanently. Paying somewhat above expected value to eliminate that risk entirely is defensible. But for low-impact risks, a broken phone screen, a canceled flight, a scratched laptop, paying above actuarial value for certainty delivers a much weaker case. The insurance industry makes no systematic effort to help you distinguish between these two categories, because blurring the distinction between catastrophic risk and inconvenience risk is the mechanism that sells the most profitable products. If understanding the psychology behind insurance marketing just changed how you see the last time you added coverage at a checkout counter, stay with me, because the behavioral mechanisms are only half of this. The specific product categories where over-insurance is most reliably built into the design, and what a genuinely rational insurance strategy actually looks like. That is what comes next. Here are the specific categories where the math most consistently favors the insurer over the customer. Start with extended warranties and protection plans. Research on extended warranty products consistently shows that the expected payout, the statistical probability of needing a repair multiplied by the average repair cost, is significantly lower than the premium charged. Retailers earn some of their highest profit margins on extended warranty products. The person asking you whether you want to add coverage at checkout is working within a system specifically designed to monetize the specific moment of anxious post-purchase vulnerability. You just spent money on something, you want to protect it. That feeling is real. The statistical justification for paying to extend coverage on most modern consumer electronics and appliances is weak. The probability of needing a repair within the extended period, the actual cost of that repair, and the realistic likelihood you will still own or care about the product at that point all work against the math of the purchase. Second category, rental car insurance add-ons at the counter. Many credit cards, particularly those with annual fees, include rental car collision coverage as a built-in benefit. Many personal auto insurance policies also extend coverage to rental vehicles. The rental car counter specifically presents the insurance option at the exact moment of maximum travel stress and time pressure, when you are least likely to pause and check whether you already have equivalent coverage. This timing is not coincidental. Third category, low-deductible policies on assets you could afford to repair or replace out of pocket. Insurance most efficiently serves the purpose of protecting against outcomes that would be financially catastrophic, not outcomes that would be financially inconvenient. A low deductible on car insurance means you are paying the insurer to absorb small claims you could have self-funded, at a premium markup above what those small claims would have cost you directly. Raising your deductible on policies covering assets you could genuinely afford to repair or replace, while maintaining or improving coverage on genuinely catastrophic risks, is a strategy with consistent mathematical support. Fourth, insurance on credit card balances and loan payments. Payment protection insurance, sold as a way to cover minimum payments if you lose your job or become ill, has been the subject of significant regulatory action in multiple countries due to premiums consistently found to be dramatically in excess of the expected benefit delivered. In the United Kingdom, the misselling of payment protection insurance became one of the largest consumer financial scandals in the country's history, resulting in tens of billions of pounds in compensation paid to affected customers. It is a product category worth examining very carefully before purchasing anywhere. Here is the rewritten text. The framework that changes how you evaluate every insurance decision going forward is as follows. 1 question. If this event occurred and I was not insured, would it permanently damage my financial life? Or would it be painful but recoverable? If the answer is permanently damaging, insure it thoroughly with appropriate coverage limits. A major medical event, a house fire, or a liability claim, a disability that removes your income permanently, the death of a primary earner with dependents. These are categories where the expected value argument against insurance breaks down, because the downside is not just expensive, it is life-altering. If the answer is painful but recoverable, you are essentially making a bet with the insurer on an outcome you could survive financially without their help. Every dollar you pay in premium for recoverable risks is a dollar you could have kept in a self-insurance fund, earning returns available for any need, not just the specific scenario you insured against. The practical steps from this framework are as follows. First, audit every insurance product you currently carry. For each one, answer the permanently damaging question honestly. Second, raise deductibles on recoverable risks to their maximum manageable level and reduce the premium freed up by doing so. Third, eliminate products in categories where the expected benefit is clearly documented as lower than the premium, such as extended warranties, redundant rental coverage, and similar. Fourth, redirect the premium savings into an emergency fund that self-insures against the recoverable risks you no longer need a policy for. This is not a recommendation to be underinsured on catastrophic risks. It is a recommendation to stop paying above actuarial value for fear, because the only certainty in an insurance transaction is the premium you pay. Everything else is probability. And you are better equipped to evaluate that probability now than you were before this video. Insurance companies are not villains. The product of risk pooling is genuinely valuable when applied to genuinely catastrophic risks. But the industry has refined its understanding of human psychology to the point where a significant portion of premium revenue comes from people paying above actuarial value to insure against outcomes they could have survived financially. Fear is the margin. Now you have a framework for removing fear from the equation and making every insurance decision on math instead. Share this with one person currently paying for extended warranties or redundant coverage they have never actually needed. And if you want to keep removing fear from your financial decisions and replacing it with clarity, subscribe to Hidden Truth Files. Hidden no more.